Hello, everybody. Welcome to yet another session of Beyond Bulls and Bears by Team StaG. Sorry, I started a different link by mistake, and which is why this link got activated a bit late. Sorry about that. Uh, we will uh, we will start first by taking a 1 minute pause in the memory of those who got hit by the terrorist attack on Pahalgam. It's our gratitude to those who were impacted for something which they were not supposed to be impacted by. Thank you guys for that silence. Let's start the session by first discussing what could be the impact of Pahalgam event on the Indian market. Pahalgam event is is the biggest strike on the non-military strike by the terrorists on India since 26/11. Why I'm saying 26/11? Because post 26/11, all the attacks were on the military side, be it uh, Pathankot or be it India responded to both military attacks with a surgical strike and Balapur. Uh, we believe that India's strike this time could be more non-military, while it might include military, but heavily non-military, and that we are seeing already with the Indus Water Treaty being discontinued. Let's discuss what is the Indus Water Treaty. Oh, some of you may be aware of it, but let me just repeat it for the sake of those who don't. Indus Water Treaty was a treaty signed between India and Pakistan with the help of World Bank in September 1960. It is about the use of the Indus waters, which is the sum of the six rivers on the west of Kashmir, which flows from India into Pakistan. India holds the upstream position while Pakistan holds the downstream position, which means India can decide the flow of the water by building dams and water storage. And both the countries agreed to share the intel around it, which India used to do. With the discontinuation of this water treaty, it means that India will randomly decide by on its own will how much water to release and how to release, and will not share that data with Pakistan. The impact of that on Pakistan could be huge over that coming period because Pakistan's agriculture need and water need on the border with India depends heavily on this water treaty. What it also means is there is going to be no plan. Pakistan cannot plan how much and water will come in terms of both quantum, high or low, and which means they need to plan and invest more on building their storage and control because India can increase or decrease the flow of the water based on their decision. This, for me, is a huge joy to Pakistan. I also believe that India sooner or later will also do some military action because that's been their stance over the past few cases. And with the upcoming Bihar elections, this government will have to show a stern action because otherwise it will have a political impact. Will this lead to a probable full war? I don't believe that because I think India realizes that in case of full war, the loss is more to India than to Pakistan because there's a lot more stake in that. And the risk of involvement of other countries like China into it will make it uncontrollable as we have seen in the past war. So India will probably have a constrained yet some military action, but I think between 2611 and today, 2 decades have passed. In these 2 decades, India has become diplomatically, globally, lot more acceptable than it was in the past, and hence probably the Indian government will use the external affairs ministry to put more economic constraints on Pakistan, or as USA, sanctions on Pakistan, to create an environment where Pakistan will probably have to come and stop this terrorist activity. But I do believe that a lot of action will be shown on paper, and that may lead to more volatility in the market, already being struck by the volatility driven by Mr. Trump. So Sonora's view here is that we will see volatile times, but the direction of the market remains upside till there is a major negative news, as the earning season will drive the market rather than anything else. Now let's come to earnings season. This was a slightly busy week. We saw mid-cap IT's results. Mid-cap IT's reported better numbers than their larger peers. I think that was more to do with the fact that they are contributing smaller parts to the larger projects, and hence the visibility of those smaller contracts is more in this uncertain environment compared to larger ones. And the margins for them also continues to be muted. But overall, I think revenue visibility was better, which is why mid-cap IT saw some upswing in the last couple of days of this week, led by Persistent and Emphasis. Our broader view on IT remains the same, that within this global uncertainty, US economy and AI as a factor, we will not see revenue growth in the broader IT space. Then we saw the results from NBFCs and other banks. While other banks like AU, Yash, and everybody showed similar strength as ICICI and HDFC Bank, the numbers look better on quarter, and probably directionally the worst is over for the banking. We are yet to see results from the public sector bank. In private sector bank, other than IndusInd, all the majors have come out with the numbers. Axis numbers within the portfolio companies was not as great as ICICI, but overall I find the numbers to be better than what it was last quarter, and directionally I think that is in the price also, because Axis is much cheaper than the peers at this point of time. Sorry, Kotak is also left to report the numbers in the private NBFCs, we saw numbers from most of the vehicle finance companies, be it Chola, be it L&T Finance, be it Sriram, and broadly we saw lower growth there. Chola repeated a number similar to Q2, where it slowed down the growth. Asset quality remained good, profitability and margin remained good. I think given the valuations and given the recent upswing in the stock may see some correction or consolidation like it did after Q2, if not to the same quantum. But as we saw with Q3, the stock quickly bounced back. So Chola remains in a range for us, and that will be the case. It will continue to grow at the rate the earning grows, which we believe will be north of 20% for the FY26 also. Hence, we continue to be bullish on Chola. What we have seen with the NBFCs per se is that with banks getting a higher growth, MC, NBFCs may struggle a bit on the growth side. Having said that, we believe that financials will continue to drive the market up. Among the portfolio companies, Maruti and Reliance also reported the numbers. Maruti was disappointing on the margin side, driven by a lot of one-offs in terms of promotion cost related to advertisement in IPL, Auto Expo, etc. With the tailwind related, I will say, negative tailwind related to commodity prices impacting the margins. But what was good is the demand remained fairly fine, and the inventory days remained low. What was slightly more worrying was their confidence on the growth of the domestic market. They have guided for a 3% domestic market growth, which is similar to FY25. And if that is the case, then it delays the re-rating. But the management was confident of gaining a market share, which means they expect their peers to grow even lower, which probably means that the whole of auto pack may continue to drag the market, at least on the PV side. Something which we believe anyways with our Hyundai negative report, that it will be a very stock specific case. with the guidance on a higher growth on the export side, I think the blended revenue growth will be better than what we have seen in FY 25, and hence I expect Maruti to see a decent earning growth with margins coming back to normal over the next 2 quarters. E-Vitara is expected to be launched within the next 3-4 months, and the response to E-Vitara is going to drive the market. They have guided for one more SUV launch over the next 3-4 months. We will be looking forward to that exciting. It seems that EV will be more exported uh, than in the domestic market, probably for a better realization. Overall, the commentary is satisfied. I think most of the concerns are in the price because the stock is not expensive, but it does delay the strong upswing in Maruti by a couple of months. Reliance reported the number on Friday evening. The numbers looks good on the face of it. The telecom business is doing good. Uh, the retail business is doing fine. O2C saw a Y-to-Y degrowth, but quarter was strong. Fine. What was the most important point was that, as expected, the energy business has kick-started only minutely, but we saw the first gigawatt kick-start, and the numbers look good. I think it will lead to earning upgrades across the across the endless group, and with clarity over the next couple of quarters on how the numbers will stack up on the energy business, we could see a re-rating in Reliance in FY 26. In fact, if numbers surprise positively, FY 26 could be a year for Reliance. We will wait for the numbers to track it and get excited about it. But given the strong consolidation and inexpensive valuation, I think FY 26 could surprise with a Reliance performance. That will be very helpful to us. We have a 6% rating. Among the portfolio companies, these were the major results. Among the non-portfolio companies, we saw a couple of reports from broking houses and other sectors which continue to be in line. Sorry, our new portfolio company, HUL, also reported the numbers, and the numbers seems to be fine to us. Broadly, we didn't expected much volume growth on this quarter, but we believe the journey of volume growth has started. If you look at it, this quarter did better than the overall average for the whole year, and that means that directionally the numbers are looking fine. What also overall I see in the earnings season is that barring IT, we will see more of earning upgrades in index stocks rather than downgrades, which means your FY 26 exit EPS for Nifty would see an increase from where it was in Q3, which is December 2024. And this, for me, will create a base in the market. Uh, the result season continues in the next week and the next month, and we believe that as the numbers come, there will be more certainty and more confidence among the market participants. While we maintain that volatility will continue to be fairly high in the market, but in the absence of a major negative news, I don't see the market going back to the recent bottom they made. Rather, we expect the market to consolidate in the range. Technically, my team says that till market is above the 8 EMA, we touched the 8 EMA during the lows on Friday. We bounce back from there. So till we are above the 8 EMA, the traders will look at it as a buy on dip market rather than a sell on the rise market. We will keep you in updated on that in our next week talk or on Friday reflection, whichever you want to follow. Uh, I will end my talk here. As I said, over the next few weeks, few days, we could see here news around India's action, and volatility will be there in anticipation of some action from India and Pakistan. For investors, it will be a short-term blip. We should not worry about it. And Sonora believes that any such correction will immediately see buying because we will not get into a full-fledged war. That's very unlikely according to us. With that, I will end it and wait for the questions as usual. You can drop a question here in the chat or drop me a message on WhatsApp. Happy to answer. With no questions, we'll end the session. See you guys again next week, same time, same place. Thank you for being here.